Okay, welcome back to this week's episode of Make Money Count. I feel like I say this every single time I start one of these episodes, but we got a lot of news again last week and a lot of data points that are going to affect interest rates, a lot of great press releases, both from the Federal Reserve, Jerome Powell in the United States, and Tiff Macklem here in Canada. A lot of inputs that are going to affect interest rates and have already affected interest rates that I want to talk about. So thanks for watching. Thanks for listening. Don't forget to hit like and subscribe, and don't forget to comment about the things that you want to talk about. Today, we are going to talk about how what happened this week is going to directly affect interest rates. I want to go through how Canada and the United States are now diverging, how that's going to affect the Bank of Canada and the decision making, how much pain has already been created by interest rates in Canada and the elevated position that they're in, what the Bank of Canada is going to do in June, and we're going to speak a little bit about the GDP number that came out a couple days ago. And then we're going to finish it all off by looking at probabilities of rate cuts. No rate hikes are coming. Not in Canada anyways, probably not in the United States either. And I'm going to show you my new favorite chart. It's a bit of a teaser because the last thing I'm going to do is show you my favorite chart. Okay, so without any further ado, there's a great article in the Globe and Mail. It is from Tiff Macklem's speech yesterday in front of the Senate in Canada, where he says that interest rates are having a far more pronounced effect in Canada than they are in the United States. The reason why I find this interesting is that Jay Powell spoke yesterday and Tiff Macklem spoke yesterday. And if you remember, they did the same thing 2 weeks ago. And the fact that they keep speaking on the same day is only highlighting how diverging the paths of Canada and the United States are. In Canada, we have an extremely sluggish economy. So we got this GDP number out, right? We got a GDP number out that says that the economy is growing at 2.5% annualized for the month of February. Not only that, they revised the January number down, so it wasn't as hot as expected. Remember, the January number came out and we were all really worried that the economy was overheating. It turned out a lot of it was public sector spending, which was no good. Definitely not what the Bank of Canada was looking for. So we end up now with a dropping GDP number for the month of February, while the United States still continues to heat up. What's disguised in that GDP number is GDP, sure, annualized growth was 2.5%, but Canada's population grew 3%, which means that the economy is really contracting. We're dumping more people in, and the economy should be naturally growing with that, but it's not. It's still contracting. So all things being equal, Canadian economy is totally sputtering. It is definitely time for us to drop. But will we? Yes, we will drop. I don't know if it's going to happen in June, but it's definitely going to happen in July. Let's have a look at some of these articles. First off, here's a great article from the Globe and Mail where the governor of the Bank of Canada, Tiff Macklem, again, speaking yesterday, speaking the exact same day that Jerome Powell speaking, and he is telling the Senate in Canada that, listen, we're extremely confident that we're going to tackle inflation. We definitely see interest rates moving lower. I think that the only interpretation left for us now is, are we going to see those interest rates move lower in June, or are we going to see them move lower in July? And how much lower are they going to move this year? And what sustained damage is that going to do to the Canadian consumer and to the real estate market by continuing to hold off on those rate drops? So we spoke a little bit at the start about the GDP number. If you want to pull up a great article, as always, in Better Dwelling, where they explain that the GDP number was way lower than was expected. Not only that, they revised the January number lower. I really like Better Dwelling. Like, these guys always get it right. They're always focusing on the pieces that are going to affect interest rates, right? And that should be affecting the economy. Consumer is stretched, right? Like, we see it constantly now. Phone calls come into our office and it's people that have been holding off for a period of time on refinancing to higher rates, on borrowing a second mortgage, but they just can't hold on anymore. Everyone has been anticipating these rate drops, but the longer we draw out the rate drops, the more the people that are holding on just can't hold on anymore. So speaking of holding on, there's an Urban Nation article that just speaks to the state of the condo market. Sales of condos in Q1 were at, since the 90s, the lowest we've ever seen them. So the average was about 5,000 sales a quarter over the last 10 years. We were at 1,400 sales for Greater Toronto area, Greater Hamilton area for the last quarter. That is a really low number. The only number that came close to being that low was in the depths of the financial crisis in 2009, and it was lower. It was sub 1,884 sales. Urban Nation always puts out great data, and this just highlights the state of the real estate market. It highlights the lack of confidence that the Canadian consumer has right now. Everyone is waiting for interest rates to make a move. The question now just becomes, how much longer are they even going to be able to make a move if interest rates stay so high? And how many people will just be kind of turned off for a long time on this housing market? And TD Bank also released their economics report, just saying, it's kind of this, we're just nudging forward slightly. Home sales are way down. Home prices are still kind of sticky because people aren't being forced to sell yet, but inventory is creeping up. And if interest rates continue to hold and not drop, inventory will continue to build up. And that's how we'll see a drop in housing prices. So I don't think we're out of the woods yet. Hopefully the idea of a July rate cut brings that level of confidence back into the market for homeowners. I'm going to show you a couple of slides, including my favorite graph, that really highlight that even with a July rate cut, we're in this position where we may be kind of hand-tied because the United States doesn't cut. And if the United States isn't going to cut and their economy is heating up, we have a problem, right? Canada imports a lot of stuff from the United States. The Canadian dollar is weak and the American dollar is strong, and we're importing all of these goods into Canada. That's inflation, right? We can buy less American goods with our dollar. Therefore, the price of those goods increases. The input price increases. Inflation goes up because our goods become more expensive simply because our Canadian dollar is worth less. In addition, the Canadian dollar is worth less, so we're selling more stuff into the United States. So hopefully that helps our economy. The problem is that it's definitely going to be stimulating inflation with a much lower dollar. The Bank of Canada is going to be aware of that. And as a result, are they going to slow down the pace of our interest rate cuts? It's very likely. In the meantime, if we don't drop interest rates, we're seeing our economy crumble. The only thing that's hiding the fact that our economy is crumbling right now is that we've got this population influx. 3% population influx should mean that zero growth is 3%, but it's not, right? Our growth is actually at 2.5%, which means technically in February, our economy contracted 0.5%. Let us flip over to the bond yields. Okay, bond yields, always telling us a story. You know what they're telling us lately? Gradual decrease, but still really, really tightly range bound. A story of a bit of a shy bond market that isn't really sure how much we're going to see as far as rate drops. Listen, we got told a long time ago that this was going to be a long process back to lower interest rates. Obviously, we got told it was going to be market dependent. I think we always are going to have to expect the Bank of Canada to err on the side of a recession rather than erring on the side of inflation. And my only concern is if we err on the side of a recession, how difficult is it going to be for us to stimulate our way out of that recession? Anyways, bond yields range bound at 375 on a 5-year Government of Canada bond. I don't think that's going to change. I think we might see that drop off in advance of the July meeting. It might go up higher after the June meeting, or maybe based on what the Bank of Canada says in the June meeting, maybe we see it tail off. If I was going to bet what was going to happen, I would say June 6th meeting, Governor of the Bank of Canada says, we are super close to cutting interest rates, like really close. And it's going to happen very soon, and it's going to be data dependent. And then in July, they'll have a chance to have another month's worth of reading how bad the economy is. And then they'll punch in a 25 basis point drop in July. And from that point, we know the way central banks behave. It's this kind of slow, steady course. So we should see successive rate drops. And it is my sincere hope for the Canadian consumer, for real estate as an asset class, that those drops lead to a firming up of the supply and demand side of that supply demand chain, and we start seeing transactions again, because this whipsawing nature of the market is not healthy. Okay, so everyone knows this is my favorite chart. Today, this isn't my favorite chart. Okay, today I'm just putting it up here because I notice a lot of the comments relate to this chart every time. People hear me saying there's, 68% probability that interest rates are going to drop, or that the Bank of Canada is going to reduce interest rates by 25 basis points in June. And I see in the comments like, where does this guy pull these numbers from? Like, how do you know it's 68%? Listen, I don't know it's 68%. All I'm saying is that there's a specific market that trades in bankers' acceptances. And that market, the C-door market, predicts based on what these are selling for, what people anticipate the probability to be of a Bank of Canada decision or move. And we know we can extrapolate that information and we can convert it into a specific percentage every minute of every day. And this minute of this day, that percentage is 68%. So 68% chance of a June rate cut by the Bank of Canada. Like I said, if you're a betting person, bet against it. I don't think we're going to see a cut. Okay, so September of 2024, we've got a 33% implied probability of a 50 basis point drop. All that tells me is it's 100% certain that we're going to see 25 basis points by September, which means the July meeting. And it is my hope that after that, we continue, like I said, to see 25 basis point drops. Because if we do not, housing prices cannot stay where they are right now. Which brings me to, drum roll please, my new favorite slide. You want to make it even bigger? Make it, yeah. Okay, let's really enjoy this chart together. Okay, you can see now how big we've made this chart. It's because it's my favorite chart. Great job, Axelan_GTA. Please go to Substack and support this guy. This is not his only amazing chart. I'm going to feature them more often in our podcast because I think that they're incredible. Okay, so check this out. Along the y-axis is the average price of a home in Canada. Along the x-axis are mortgage rates. 1%, 2%. This is much harder than you think it is. 3%, 4%, 5%. Plotted inside this chart are different annual average home prices in Canada. So if you can follow along with me, above the 5% is 2006. You see that? We got an average home price of over $500,000 in 2006. And in 2007, that home price goes kind of horizontally because, if you follow it along, on the x-axis, the interest rate for a 5-year, there's got to be a 5-year fixed rate mortgage, that interest rate increases. These are obviously non-discounted mortgage rates. So what he's plotting here are the oligopolistic interest rates of the banks in Canada. If you come to Cannect, you can do way better. For instance, right now, you would be getting a 4.39% 5-year fixed rate with us, which is by far the best rate on the market. Shameless plug there. Sorry. Okay, so back to this favorite chart. You can see there's a kind of pinkish orangey line there that says the attainable price for investors. And then there's a blue line that says the attainable price for home buyers. And anything above those attainable price for investors and attainable price for home buyers would be theoretically deemed to be overvalued. And anything below would be deemed to be undervalued. And you can follow along as the price of a home in Canada steadily increases from 2006 to 2007, 2008. It dips a little in 2009 because we have the flash crash. And then it continues to move higher. And where you can see the last data point for 2022, where mortgage rates were lower than they are right now, average home price, above $1 million, you can see just how overvalued the market is. We have to understand the dynamics behind the real estate market, right? And this thesis that we see from all of the Canadian banks and economists has been almost as if the real estate operates in a vacuum, right? The only input that is going to affect real estate prices going forward is interest rates. But that's simply not true, right? The first thing they teach you in economics is nothing operates in a vacuum. You have to pretend. So in like Econ 101, the first thing your professor starts telling you is, we understand this doesn't operate in a vacuum, but we're going to strip out variables in order to help you understand how supply and demand works. Well, you can't do that in the real world. So when the Canadian banks tell us that, sure, property values are low, but once interest rates drop, property values will go up, it's not that simple, right? Because when interest rates are high for an extended period of time, an economy starts to break down, right? We have two things happening in our economy right now. We have immigration, massive immigration, 3% annual year-over-year increase in population, and we have high interest rates, which is spurning unemployment. So now we have more and more people out of work. We're bringing more and more people into the country. Our country isn't growing, and we expect now that we're going to drop interest rates, drop immigration, and housing prices will just start to rebound. I sincerely hope that I'm wrong and that this does behave in a vacuum and that as soon as interest rates drop, property values come back. But I worry that the Canadian economy is kind of unhealthy, right? Like we've already seen that the Canadian worker is becoming less and less productive. So we have decreasing productivity, increasing unemployment, high interest rates, and now we're going to shut off the immigration tabs. As a result, we may not have the same demand for housing. We may not need this massive amount of housing. I predict that we are going to see this housing shortage crisis that we're talking about. We're going to see that evaporate. You know what helps remove a housing crisis? Is if you can affect change on the demand side. And how do you affect change on the demand side? How do you get people to pay less for housing? Take away their jobs. People don't have jobs. They're not going to be able to rent the same places that they wanted to rent. So rents will drop. We've seen rents kind of precipitously increase over the last 2 years since we came out of COVID. Well, now we're going to start seeing average rents tick down. And hopefully we can catch this. Hopefully we can save our economy with lower interest rates. We can start adding to housing and we can continue to build out housing supply. But I don't know if we're going to need that housing supply. Anyways, let me know your thoughts. We covered a lot of ground today. If there's anything you want to focus on more, let me know. Again, thank you very much for listening. Thanks for watching. Connect. Make money count.